Today we have just to use more or less 15 minutes of this session number 4 to come to an end of the first part of the course, which is devoted to fundamentals of private equity and venture capital, because today, if you remember, we have to highlight just the two last clusters of our private equity map. That means we have to discuss about the replacement financing and the vulture or distressed financing, just to come to an end of this part. Later, we have to start the part number 2 of the course, a very, very important part, which is devoted to the understanding of the legal and fiscal framework of private equity and venture capital. In my opinion, every part, it's obvious, of the course is really, really important, but my opinion, this is my personal opinion, not as instructor or professor, but my personal opinion as a practitioner of private equity venture capital is that legal framework and fiscal framework is really the focus and the most important part of the course. Okay, because if you don't understand legal framework and fiscal framework, okay, you can evaluate a company, you can know what are the clusters, that's great, but really you don't have the tools to manage. So it's really, really the most important part of the course. But however, let's focus on the last part of the part 1, which is devoted to the last two clusters, which are, you remember, replacement and vulture or distressed financing, okay? You remember the table with the 6 clusters, okay? You have the two last clusters, and our problem is yesterday, to discuss about the definition, risk-return profile, and managerial involvement, okay? So definition, risk-return profile, and managerial involvement. These are the issues. Let's come back to replacement. I mentioned yesterday that replacement is the main cluster of private equity and venture capital in the world. That means if I jump from a country to another, it's more or less the same, the 50% of the market in terms of volume. So it's really the cluster. You remember that yesterday I specified that in the replacement we find, because I had to give to you the definition, 2 different stories, really completely different. The only characteristic they have in common is that the private equity is involved in a mature company. Okay, this is the only characteristic they have in common, but if I don't consider this issue, the 2 stories are completely different. The story number 1 is a story of acquisition and growth, okay? So the first story of replacement is a story of acquisition financing. So the private equity investor gives the money to the company in order that the company can buy other players. It's a story of acquisition, okay? The second story is a story of turnarounds, whereas the intervention of the private equity is not driven, it's the only case, is not driven by a need of money. You understand? It's the only case in which the intervention of the private equity is not driven by the financial need. In all the other cluster, the intervention of the private equity investor is driven by the financial need, by the financial gap. In this case, this is not a driver. The driver is a need of turnaround, okay? So the intervention of the private equity is done because it helps the private equity to become a shareholder of the company, to stay in the board of directors, and to have the power to manage inside the turnaround, okay? So to stay in the board of directors, to become a shareholder, it's a very powerful tool in order that the private equity can manage a job, which is typically a consultant job. But as I mentioned yesterday, the capability of the consultant, the effectiveness of the consultant is completely different. Because if you are a pure consultant and you stay outside the company, okay, you can give good advice to the company, but you are not involved. If you are a shareholder, you are involved, and you will be paid only because if you are able to manage a very good job. Okay? Please remember these two stories, just to summarize what I mentioned yesterday about the double definition of replacement financing, acquisition and turnaround. Okay? These are the definitions. Risk-return profile. Okay? You remember that yesterday we tried to highlight the risk-return profile per cluster. Please remember that in startup, early growth and expansion, the risk-return profile is always driven by the trend of the financial need. That it must be automatic in your mind. Financial need means, okay, the game of size, time, and percentage you have to finance. Okay? Please remember all these characteristics. In this case, I do believe that risk-return profile is different if I consider the acquisition story or if I consider the turnaround story. The risk-return profile is different. In the acquisition story, the risk-return profile is related to two different drivers. The two drivers are also named operational risk and financial risk. So I repeat, in the acquisition story, the risk-return profile is driven by two different issues, is driven by two different factors. And generally, practitioners love to name these two factors operational risk and financial risk. Financial risk. Operational risk, it sounds probably obvious. The risk-return profile of the acquisition is related to the risk of the business of the company you buy. Okay? Simple, stupid, but fundamental. Okay? The risk-return profile of your investment as private equity investor is related to the risk and to the characteristic of the business you decided to buy, okay? One story is if I give to you money, your name is Daniele. If I give to Daniele money to buy a player which stay in France or Germany, okay, it depends from the sector, but another story is if I give to Daniele money to buy a company which stay in Jamaica or in Belize, okay? It's an acquisition story, but the risk of the business, the characteristic of the business, Daniele decided to buy is completely different. So my risk-return profile as private equity investor is driven by the characteristic of the business the company decided to buy, okay? But we don't have simply an operational risk, which is, I repeat, obvious but important. We have also a financial risk. And the financial risk is one of the issues which is involved in the financial crisis in 2008 and 2009. Why? There is also a financial risk. Take care about it. Let's imagine this story. I am the private equity investor, okay? I am the private equity investor. Let's imagine this is Daniele's company, okay? Daniele company, okay? Is it okay? Daniele needs 50 million euros. For what reason Daniele needs 50 million euros? Because he has to launch an acquisition campaign, okay? We evaluate together the business risk of the target Daniele would like to buy. That's perfect. We decided to give to Daniele 50 million euros, okay? When we decide to give to Daniele 50 million euros, another story starts. And the story is, me, as a private equity investor, I give 50 million euros to Daniele, or I try to do something else. Something else could be this story. I don't want to invest 50 million euros because I don't have 50 million euros, because it's too much, and I don't want to reduce other opportunity of investment. Okay, many reasons. It's my problem, it's not Daniele's problem. I say to Daniele, don't worry, I give to you 50 million euros, you understand? It's my problem as a private equity investor. What I can do? I can do something very, very simple, and what is very simple is called leveraging the acquisition. That means I create a new co, okay, a new co. In this new co we have equity and debt, right? The private equity investor invests, for example, only 10 million euros, and I start looking for debt all around the world, all around the market, through bonds, through loans. Is my problem, it's not Daniele's problem, okay? Let's imagine that I'm able to get from the banking system 40 million. Is it okay? And now the new co has in cash 50 million euros, and these 50 million euros are given to Daniele in the equity side. Is my problem, is not Daniele's problem. You understand? Is it okay, guys? Yes or not? But in this case, for the private equity investor, not for the company, for the private equity investor, another risk happens. And the other risk is a financial risk. For what reason? Because the private equity investor invests only 10, okay? He raised money through debt using 40 millions in order that we have 50 million euros in cash, but obviously the private equity investor will repay the financier by the capital gain, okay? Because when I exit from Daniele's company, and I hope, let's cross our finger, the capital gain is at 30 million euros, in order that I invest 50 million, and I have now in cash 80 million euros, we are very, very happy, okay? Because I use 80 million euros to pay 40 million of debt, to pay the interest. I can say I spend 40 plus 10, 50 millions, and the final result is that I invested 10 million euros, and I have in cash 30 millions. At 200% of capital gain. Are you satisfied? Are you satisfied? That's great. Is it okay? But this is a financial risk. And the financial risk means everything is okay. It's a big gamble, okay? Everything is okay till the interest rates are very low, and or in the market it's very easy to have a very high capital gain, okay? If we stay in a world like 2005 and 2006, in which interest rate was very low, it was easy to get money through the banking system, and the stock exchange was working a lot, and multiple was increasing and increasing, it was very easy to raise money by the banking system at a very cheap cost and to have a very high capital gain. You understand? But in 2007 and 2008, the interest rates are increasing a lot, and in the same time, the stock exchange is falling down. If the stock exchange falls down, the multiple, okay, are not working, and it's very difficult today to have a very high capital gain. But so if interest rates are very high and it's very difficult to have capital gain, it's a disaster for who? For a lot of newcos you created all around the world. You understand? Because the debt the debt has an higher cost, but in the same time the financiers start to say, dear Stefano, please remember that you have to repay the debt. And you are very worried because it's very hard today to have capital gain. Okay? Many private equity investors nowadays stay in a crisis because of the problem of newcos they created to leverage a lot the acquisition financing. Okay? The financial risk obviously is related to the leverage. Okay? In 2005 and 2006 was very common to create NewCos with a leverage of 6, 7, okay? 10 million euros equity, 70 million euros debt. Nowadays, in 2009, the highest level of leverage is a 2, okay? 10 euros equity, 20 euros debt, no more, okay? But this is the story of financial risk, okay? Is it okay, guys? So it's okay, the story of risk return, which is related to operational risk and to financial risk. This is the story of the acquisition. If we move to turn around, the risk return profile is not related to this kind of factors. So the problem is not operational risk and financial risk. The only risk we have to face is a problem-solving risk. The only risk we have to face is a problem-solving risk. I stay in the board of directors, you remember the story of yesterday, and I have to solve the problem of the founder of the company, which is 78 years old. This is the problem. It's not a financial problem, it's not an operational problem, it's a problem of governance. So the risk return is related to my capability of problem solving. It's obvious that in a classroom, that's it, okay? Problem solving is problem solving. If you stay in the real world, you have to solve the problems. And to solve the problems, we don't have any theory, you understand? No books is helpful for you. Because you have to manage with people, you have to find compromise, and that's the story. It's a story of people management. It's a story of people management. The higher is your credibility and your standing, the easier probably you will find a solution, okay? Because of your reputation and your capability to give very, very good advice to a lot of people that staying together in a sort of crisis in the corporate governance of the company. This is the story of risk-return profile in turnaround. Managerial involvement. Managerial involvement. Also, in this case, the managerial involvement is completely different if I consider acquisition and turnaround. In case of acquisition, the involvement is a typical investment banking involvement. Okay? In the acquisition story, the managerial involvement is a typical investment banking involvement. I hope everybody knows what is an investment bank. In order that you understand my language, what does it mean in investment banking involvement? Give me the right words. What is an investment banking involvement? Please identify the magic words to identify the meaning of investment banking involvement. Scouting, advisory, arranging, and financing. The four magic words. Scouting, because you have to help the customer to scout the potential targets. Advisory, because you have to give to your customer the legal and the fiscal service to launch the acquisition. And sometimes, if you have to launch a public offer, it's not so easy. Third, scouting, advisory, arranging, you have to negotiate with the potential target the deal, so you have to arrange the deal. And last, financing. If it is necessary, you have to provide the financing for the NewCo, which is necessary for the acquisition. Okay? I don't know if it is too early, but I try to do that. I would like that you have the feeling replacement financing in acquisition is a typical investment banking job in which It's not so relevant that you know the business. It's not so relevant that you stay in the network or you are able to manage lobbying activity. What is important is that you are very, very smart investment banker, because it's M&A. In the other cluster of private equity, it's not relevant that you are a good investment banker, because the characteristics of the involvement are completely different. Networking, lobbying activity, capability to revise the business plan, to enhance managerial transfer and so on. These jobs are jobs which are not related to investment banking. Okay? So what I would like to say, many private equity investors in acquisition are owned by investment banks. Many other private equity investors which stay in other clusters are not owned by investment bank, because the jobs is completely different. Okay? Just to say, in order that you understand, sorry if I'm so cruel, private equity in acquisition financing is a perfect job for Lehman Brothers. I'm serious. A bit cruel, but serious. Okay? The other clusters, seed financing, startup, early growth, they are not job for Lehman Brothers, Merrill Lynch, JP Morgan. Okay? But acquisition finance is a perfect job for investment bank, because scouting, advisory, arranging financing. Okay? And the involvement of turnaround financing, the managerial involvement is a 100% involvement, because you have to stay in the board of directors and you have to interact with the different shareholders, with the different players, in order that you are able to identify the new governance of the company. Okay? As practitioner says, in turnaround financing, your managerial involvement is 24 hours every day. You stay in the company and you have to solve the problem. So it's a 100% involvement. Okay? What does it mean, 100% involvement? I don't have any idea. Good luck. You have to solve the problem. Okay? Okay, guys? It's okay? That's great. I would like to, a very, very small snapshot, but to have an idea of what does it mean, a 24 hours day involvement. You remember the story of the two daughters, the smart one, the stupid one, and the two husbands? You remember? You remember? Just to give you an example, what does it mean, involvement? In your opinion, how is it possible to convince the stupid daughter to exit from the company? Give me an example. How is it possible to convince the stupid daughter to exit from the company? Give me an example. If you are the private equity investor, you have to solve this problem, okay? Not because it's written in the book, because it's human life. Yes, you have to pay a lot, okay? So how much? You have to negotiate, okay? Because the stupid daughter can say, okay, I perfectly understand that I don't want to stay in the company, but I would like to have 100 million euros. And the private equity says, oh, no, it's too much, 100 euros, okay? So we try to negotiate, is 80 million euros, but the problem is that we have to identify where it's possible to find 80 million euros. You have to go to the other daughters and to say, okay, your sister would like to have this amount of money, what we can do? And we start to identify, for example, real estate, buildings, okay? In order that we try to sell this building, but we can sell some buildings, and we raise 40 million euros. We have to come back to the other sister to say, sorry, you have 40 million euros in cash, we have these other buildings, but you understand, these other buildings are, I don't know, historical heritage. It's a nonsense to sell, okay? So I can give to you the ownership of that building. And you can say, Stefano, I understand, it's fine, it's okay to have this building, but I would like to have 10 million euros more. I have to come back to the other sister and to say, it's okay, but 10 million euros more, okay? This is an example. of 24 years involvement. In this case, the problem is to be able to negotiate the selling of buildings and real estate. Okay? In other cases, we have to identify the right solution to protect the future right of all the sons. Okay? Because the stupid daughter can say, okay, I exit from the company, but I would like that my 3 sons will have an option to stay in the company. Because I'm stupid, but I'm a good mother, and I would like to protect the 3 sons. Okay? So please identify a solution in order that the 3 sons have the opportunity to stay in the company in the future, like the other 2 sons. Okay? These are examples, very practical examples of what does it mean 24 hours in involvement, just to have an idea. But however, we'll have a lot of time to discuss about that in the last part of the course when we'll discuss about deal making. But let's move to the last cluster, okay? The cluster of the desperation, vulture financing, okay? Because it's desperation, because in this cluster we don't manage the financing of a good company, but the problem is to deal the financing of a bad company. Okay? Take care that in vulture financing you are a bit unlucky. In the definition, also in this case, we have 2 different stories. The story number 1 is a story of restructuring. And the story number 2 is a story of distress financing. Okay? So inside vulture financing, we have 2 different stories, and the 2 different stories are the story of restructuring and the story of distress financing. What is the difference? The difference between restructuring and distress is driven by the law. In restructuring financing, the company is still working. You are out of every procedures because the company is still working and you don't have the problem to manage special laws coming from your civil code or coming from the common law, okay? Because the company is still working, okay? The Latin sentence is the company is in bonus, okay? Is still working. You stay in the civil code and in the common law. You don't have to use any procedure, okay? So I do hope that it's clear now the meaning of restructuring. You are financing a company because you want to help the company to restructure itself in order that the company will be able to produce again cash and profit. Okay? In this case, your job is tremendous because you are financing a financial need, but this financial need is bad because the financial need come from a lack of cash flow and or come from a lack of profitability. So you don't have cash, not because you are investing, but because you are not able to produce cash flow and you are not able to produce profit. So restructure is a very tremendous gamble coming from the private equity investor. Why is a gamble? Try to remember it, because it's the unique cluster in which you invest 50 million euros, just to give an example, and you know that 25 million euros are not used to produce profit, but they are used to fill the gap and to repay other financiers. So you invest 50 million euros, but you have to create value using only 25. That means the performance you have to generate using 25, it's really incredible. You start your job with a tremendous disadvantage. You understand? It's obvious that you jump into this world only if you believe, if you do believe that you have more than one chance that the company will start again and we start again to produce profit and cash. If you don't believe it, it's not your job, because it's very risky. Okay? This is the story of restructuring. We stay in the definition. But we have another story, and this is the story of distressed financing. In distressed financing, the company is not working yet, the company is dead, and you stay in a specific procedure, and you are using a specific law to manage the failure of a company written in your civil code or in your common law. The company is not working. Okay? It's very common that if you stay in distressed financing, you don't negotiate your investment with the shareholders and the entrepreneur, but you negotiate your investment with the judge, for example, in common law countries, or with the people that are in charge to manage the failure, like in civil code countries, in France, Italy, and Spain. You understand? You don't negotiate the investment with the entrepreneur and the shareholders, but you have to negotiate your investment with the people that have in charge of the management of the failure. Okay? But why you decided to invest, in your opinion? Why you decided to invest? Because you don't have any hope, okay? The company is dead. You don't have any hope. Why you decided to invest? You want to invest because you are dealing an asset sale. You want to buy some assets, or you want to buy a part, a business unit of the company, because you do believe that all around this trademark, all around the brand name, or all around a specific business unit, it's possible to build again another company. Okay? But typically, the vulture financing in distress is an asset sale. You buy asset because you do believe this asset, these assets, they still have a value, and you want to bet on the value of these assets. Okay? Is it okay, guys? Okay? Yes or not? Please remember one thing, because otherwise you don't have the feeling of the real world. From a logical point of view, distress financing is the perfect deal from a logical point of view. Because we have a company that fails, you go to the court, you negotiate with the judge, you give money to the judge, you buy some assets, and you're able to create new value all around these assets. Very simple, okay? But follow me in order that you understand where you find the problem, especially in countries which are civil code driven. Okay, so we don't have this kind of problem in common law countries like US and UK. Okay, let's imagine that you are the judge. Your name is Alessia, okay? Alessia is the judge. I am the private equity investor. Let's imagine Alessia is desperate because it's 2 years that she is managing the failure of a company. Let's imagine every day you have people that is calling to you to say, Alessia, we want to have our money. I am a supplier, okay? I want to have money from the company. This is your life. And you have to say, be patient. I have to find a solution, okay? One day, I will get to your office and they say, how are you, Alessia? And you say, I'm desperate. I know. I have the solution for your problem, Alessia. I have a bill, 30 million euros. I give to you the bill. You can use 30 million euros to satisfy the suppliers that call you every day, okay? I want in change just a thing, some asset of the company. I'm very sincere. I would like to have this equipment, this factory, and the brand. That's it, okay? And you solve your problem. When Alessia comes back home, is thinking, and there are two different possibilities for Alessia. The possibility number one is That's great. Stefano is very kind. Tomorrow morning I will give a call to Stefano and I say, thank you very much. I take the bill, 30 million euros. I give a call to many suppliers and to say, hey guys, we have money. And I start sleeping, okay? The option number 2, which is very common, is Alessia is not convinced. And Alessia says, if I say yes to Stefano and I take the bill of 30 million euros, this is not the right job for me as a judge. Because Stefano is offering to me 30 million euros because probably is evaluating that there is a greater possibility to have a capital gain. So if I say yes, is a damage for the suppliers. And tomorrow morning, I give a call to Stefano and I say, dear Stefano, my answer is no, because I want to go on in working, and so Alessia will work for other 2 years and she'll be able to gather from the asset 5 million or more. And the suppliers are not satisfied. But in civil code countries, this is the classical dilemma for judges and for people that have in charge the management of distressed company. In common law countries, we will see, like US and UK, you have special laws in which is written, if there is a failure, the judge must ask for offers coming from private equity investor. It's written in the law. So the problem of Alessia is not to say Stefano is a wise man or no. Because by law, Alessia has to give a call to many private equity investors to launch an auction between the different private equity investors. Very simple. In civil code countries, Italy, France, Germany, the strategy is completely different. We have a judge, we have a man or a woman that has in charge the management of the failure, and the task is to try to satisfy the suppliers. Okay? Take care about it. Something, and we come to an end, about risk-return profile and about the managerial involvement. Risk-return profile, in the story of restructuring, is, again, if you agree, an operational risk and a financial risk story. Because the risk and the return are driven both from the business and your capability to create, again, value, but risk and return is driven also by financial risk. For what reason? Because if you invest in a company which stays in crisis, probably the liability structure is not good and you have a lot of financial risk. So if you invest in this kind of company, you have to face a lot of financial risk. On the contrary, in distressed financing, the risk-return profile is related to your trading capability, to your capability to buy assets and to sell them in higher prices. It's not an operational risk and a financial risk. It's a pure trading risk. It's a pure trading risk. Okay? And trading risk is related, guys, to your network. If you don't have network and you buy the brand of a company, you are not able to sell it. Okay? If you have a very huge network, you buy a brand, I don't know, you buy Ferretti brand, okay? Tomorrow morning you give a call to a private equity investor or to another investor who stay in Abu Dhabi, and you say, dear Abu Dhabi investor, would you like to buy Ferretti? Okay? You bought it at the price of 50 million euros and you sell it with the price of 150 million euros. That's great. How many time you spent? 24 hours. For what reason? Because they have a huge network. It's a trading risk. Okay? A completely different story coming from restructuring. And last, just 1 minute, managerial involvement. I do hope it's very simple. The managerial involvement in restructuring is, again, a 100% involvement. But with a tremendous difference. Take care about it. You don't simply stay in the board of directors. You don't simply stay in the company 24 hours per day, but in restructuring is the unique cluster in which the private equity becomes the entrepreneur. Because the company stays in a crisis, and you don't provide simply money, but you have to become the entrepreneur because the company stays in a crisis. So restructuring is a tremendous job, and it's a proper job only for private equity investors which have strong skills, strong CVs, strong stories in the industrial sector, because otherwise you cannot deal restructuring. An investment banker cannot manage a restructure. But not because he's a stupid, but because he's not an entrepreneur, he's an investment banker. Distress financing typically has no involvement in a company because it's a pure trading job. In distress financing, you are not involved in the company, but it's a pure trading job. Trading job means you must be very smart to negotiate with the judge, and you must be very smart to sell the asset to other people. So it's a typical trading job, but you are not involved in the company because you are buying and selling assets. Okay? Now I would like to stop with a final remark. When you start studying the managerial involvement column, please remember that the jobs you have to do, your involvement is completely different. I do hope you start to understand that the managerial involvement is completely different. Please, it's quite important because when we discuss about strategy and positioning of private equity investor, the strategy and the positioning is related to the managerial involvement you have to do. Because in all the cases you have to invest money, and everybody has money. But the managerial involvement is completely different, and the positioning, your strategy, your business model as a private equity investor becomes completely different. Because one story is to stay in a company and to become an entrepreneur, another story is to manage trading, another story is to act as a consultant to manage turnaround. You are investing money in both cases, but your capabilities are completely different. Okay? Take care about it, and now we have to change the perspective, and we start the session number 2 of the course. The session number 2 is devoted to legal and fiscal framework. So, from today, we start discovering who are private equity investors. Because till now we simply know, okay, we have private equity investors. And let's come back to the lesson number 1. Private equity investors are financial institutions which are devoted to invest in private equity. Okay, you remember, we simply know it, but we don't have any idea about who are those financial institutions. You understand? Legal framework is fundamental to understand who are private equity investors. Second, fiscal framework. It's quite useful to understand how it's possible for different vehicles from different entities to create value, because taxation has an impact on the capability to manage profit and losses, you understand? But let's start from the legal framework. Now, I really need your attention at the very maximum level for 2 minutes. Obviously, you don't relax later, but okay, this is the peak of your attention. When I have to start talking about the legal framework, my problem is legal framework about what? About Italy, about Europe, about US, about UK, about emerging markets. So you understand it's a problem for me, okay? Legal framework about what? In this case, I am very lucky because in private equity in the world, this is by chance, by God, okay? Not by theory or by handbooks. It happens, okay? But in private equity in the world, we find that the market, the world is really divided into two different blocks. From a legal framework point of view, in the market, we find two different blocks. Okay? The block number one is the European Union bloc, in which the countries belonging to European Union plus newcomers in European Union decided to apply a certain legal framework for private equity. Okay? When I say European Union, I mention the 25 countries minus UK, because when we discuss about financial regulation, I do hope that you know that UK is out from European Union, because UK doesn't apply the European Union rules for the financial system. So when I say European Union, is 25 countries minus UK plus 8 countries that stay in a waiting list or they are demanding to enter the European Union. So 24 countries plus 8 countries, that means 32 countries, European Union. Okay? On the other block, you have two main players, and the two main players are named United States and UK. I want that you remember that US and UK covers the 50% of the market of private equity in the world. Okay? So it's enough to say US and UK are a bloc, because they represent the 50% of the market. Take care, guys, not because only American people and British people invest in their country. Absolutely not. We have a lot of investors coming from outside that they create a vehicle in the United States to invest in their country. You understand? If Italian investors decide to use a US vehicle, and this US vehicle invests in Italy, the volume are relevant for US. You understand? That's the reason why US and UK represent the 50% of the market, because of a strong usage of their vehicle coming from a lot of investors from every part of the world. US and UK are not alone, because all around US and UK, generally, most of the other countries follow the same approach of US and UK. So when I say China, India, emerging countries like Brazil, so they follow the same pattern of US and UK. Okay? So we have two blocks. What is important is, okay, we have two blocks, we understand. I can say it another way, civil code countries, common law countries, more or less is the same story. But what is the main difference between the two blocks? The difference is tremendous, because in the European Union, private equity is considered a financial service. And because it's a financial service, the private equity must be supervised and regulated. Okay? In US and UK, take care, the private equity is not a financial service, but is an entrepreneurial activity. And because it's not a financial service, is not supervised and is not regulated. You understand? The difference is tremendous. Because if you stay in Italy, France, Spain, and blah, 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 you have to follow a lot of rules, and you are supervised by Mother, Bank of Italy, Banque de France, and so on. You stay in US and UK, you don't have rules, and you are not supervised. I do hope that you understand the pros and cons are completely different, because to stay under supervision means a lot of constraints, a lot of rules, a lot of costs, but you are safer. You stay in US and UK, no constraints, no rules, no costs, but the risk is higher. So the business is the same, but the risk-return profile in European Union and US and UK framework is completely different because of the different strategy of regulation. okay? We will discover everything, but I would like that you remember it from the startup, okay? This is a huge difference. Because of this difference, we stay in Italy, we stay in Europe. I like to start from European Union. So the focus for today is to start to analyze the European Union framework considering private equity. Before doing that, is it okay, the definition? Is it okay, the difference? Is it okay, guys? Okay. European Union, this is a problem now. My assumption is that, I do hope so, you know everything about financial service regulation in Europe. Is it true? You say no, okay? Other people? Don't worry, I don't evaluate you. What is important is that we do the right stuff for everybody. It's better to summarize? Okay. It's the typical Italian approach, okay? Italian audience doesn't say yes or not. It's obvious that the common feeling is we don't know anything about that. But, okay, we take care about it. And the teacher says, do you want that I summarize? You say, yes, it's okay for people that don't know anything. Not for me, but okay, it's a classical story. So I summarize, okay? And if you have some issues or some problems, stop me. Okay, my task today is not to face the problem of financial service regulation, because otherwise we need 5 or 6 hours to do that. But what I would like to do is simply to highlight the general characteristic of a financial service regulation in Europe, and second, to identify in a perfect way the regulation of private equity inside the general regulation of the financial system. Okay? Let's start. What are the pillars of financial service regulation in Europe? In Europe, we have 2 pillars which represent the framework of financial system regulation. The 2 pillars are named, you know the 2 names of the 2 pillars, the 2 body of laws which represent the regulation of financial system in Europe. They are called Banking Act, Banking Act, 1993, and Financial Services Act, 1998, okay? So in Europe, the regulation for the financial system is covered by 2 big acts, the Banking Act and the Financial Services Act. We don't have other laws. Please remember what is the story of Europe. In Europe, European Union writes a directive, okay? But the European Union has no power to make laws, so European Union invite all the countries to transform a directive into acts that mean in laws which are compliant with the country system. So we have the banking directive. France, Italy, Germany, and blah, 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 decided to say, okay, this directive became a country law and became an act for Italy, France, Spain, Portugal, and blah, 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 not for UK. Okay? This is the game in Europe. So what happened is, in Europe, in the 32 countries I mentioned before, in all these 32 countries, we have the same Banking Act and the same Financial Services Act. It's written exactly in the same way because they were European directives that were transformed into country law. Okay? Is it okay? This is the general game of European Union and other countries, not related to financial services story. Is it okay till now? What is important is that in Europe we don't have other laws and other acts regulating the financial system. Take care, we have only 2 acts. Okay? The problem is the Banking Act and the Financial Services Act regulate what? Okay? What is the purposes? What are the purposes, sorry, what are the aims of regulation of the 2 big acts? Let's start from the banking system. The Banking Act develops 3 different ideas. The idea number 1 is important, sorry, as a brief summary about the system. It's not relevant for private equity. It's a summary for the system. The 3 big issues which are regulated by the Banking Act are, first of all, the definition of banking. You know what is banking? What is the definition of banking which is given by the Banking Act? You know what is the definition of banking? What is the definition of banking? What is banking? Guys, what is banking? Banking is activity in which you manage in the same time, collecting money from common people through deposits, and you give money through loans. So banking activity is the management in the same time of collecting money through deposits and giving money through loans. This is banking activity. You remember? Why is a critical activity, banking activity, in whatever kind of country? It is a critical activity because you are managing savings of a country, because you are collecting money through deposits, and in the same time, you have a very strong impact on the process of generating money, okay? So banking activity is fundamental in every country because it has an impact on savings of a country and on the process of generation of money. So if you want to manage and control inflation, you have to control banking. If you want to protect savings, you have to control banking. You understand? Is it okay? The main problem for every country is to say the banking activity is too precious, too relevant, and it's fundamental to identify which players can manage banking. The answers in Europe, but the same in the US and in all the other countries, is that only banks can manage banking. Only banks can manage banking. So the Banking Act identifies a first financial institution which is called bank, okay? The bank is the only institution that can manage banking, okay? The big problem, tremendous in 2009, is a bank can manage, can offer other services. This is the big question. A bank can offer, can manage other services, in your opinion? In Europe, before 1993, the answer was no. A bank cannot offer other services. For what reason? Because it's too risky. Because to manage banking activities is so relevant, is so precious, is so important that it's better that a bank doesn't offer other services. The answer in Europe after 1993 is a bank can offer whatever kind of service. And the bank is designed in Europe using the concept of universal bank. A bank can offer whatever kind of service, with only 2 limits. And the 2 limits are a bank cannot manage insurance activity, and a bank cannot act as an entrepreneur into industrial companies. If I don't consider these 2 limits, a bank can offer whatever kind of services. Okay? Is it okay, guys? Are you happy about it, that banks are universal? Every day on the newspaper in 2009 there is a debate about it. For what reason? For what reason? What are the pros to have a universal bank in a system? What are the pros? Guys, I would like to have your opinions. It's the debate in 2009. What are the pros to have universal banks?
Less risk.
Sorry?
Less risk.
No, other pros, other pros. Synergies, a lot of synergies. A bank can offer whatever kind of service. That means a lot of synergies you can create. And second, you have players that can satisfy their customers for whatever kind of purposes, okay? I go to a bank and I say, dear bank, I need to issue bonds. No problem, I can do that. I have to manage my assets. Yes, I can do that. I need loans. I can do that. So I am universal. I can multiply your offer and you are more satisfied. Okay, these are the two big pros of universal banks. A lot of synergies and a lot of satisfaction for the customers. And what are the tremendous cons? What are the tremendous cons to have a universal bank? Conflict of interest. Conflict of interest. You know what is conflict of interest? You know what is conflict of interest? It's possible for me to tell you a story of 2 minutes in order that you remember what is a conflict of interest and you understand the big debate that you have on the newspaper. Because the problem on newspaper in the US and in Europe now is to say, universal bank makes sense? Or is better to come back to 1993, in which a bank can manage only banking? Let's discuss about the conflict of interest story, okay? Let's imagine that my name is Lehman Brothers, or if you want, is Bank A, okay, or whatever kind of bank, okay? Let's imagine. Your name, I didn't remember your name because it's very complex.
Cindy.
No, it's simple. Okay, Cindy, okay, that's great. I'm happy for that. Let's imagine I'm a universal bank, okay? I gave to Cindy with a loan 50 million euros, okay? Now you're suffering a lot because there is a crisis, you know? So you're suffering, and I'm suffering too. Because they say, Cindy, please take care, you have to repay my debt, you understand? And you say, Stefano, I know, but I have a lot of problem, I don't have cash flow yet, okay? So what we can do, what I can do is the following. I give a call to one of my colleagues. I give a call to you. You? Your name is? Ludovico. And I say, Ludovico, you have to help me. You remember 2 years ago I helped you, and now you have to help me. There is a problem with Cindy, okay? I gave it to Cindy a loan of 50 million euros, and Cindy is not able to repay the debt. What we can do? Your job is to issue bonds, okay? And your name is? Ludovico. Ludovico says, oh, no problem, Stefano. We issue 30 million euros of bonds. I take a fee, it's not my problem. I put in my pocket a fee. I can do that. Don't worry, Stefano. I help you. And Ludovico organized a bond issuing of 30 million euros, okay? The problem is, now we have to sell these bonds, okay? What we can do? We give a call to, your name is? Aldo. Aldo is another colleague. Ludovico and Stefano go to Aldo's office and say, Aldo, we need your help. Aldo is an asset manager, okay? And we say, we have 30 million euros of bonds, okay? You know the story of Cindy. You say, yeah, I know. What we can do, Aldo, is very simple. These 30 million euros, you can spread this bond in the portfolio of your customers, okay? It's rubbish, but because you have a lot of portfolio of customers, probably they don't feel that you are inserting in the portfolio this rubbish bond. You understand? That's great. But if Cindy is not able to pay the loans, is a tragedy for me, is a tragedy for bondholder, and is a tragedy for the customers of Aldo's. If the customers of Aldo are very big, and they have portfolio of 100 million euros, for those people to have 1 million euros of the bond of Cindy, they are peanuts, okay? They don't feel that there is a problem. But if the customers are retail customers and they have in their hand only the bond of Sydney, it's a tragedy, okay? And the reaction is that they go to the bank and they say, we would like to have back our deposit, because otherwise we lose all the money. You understand? This is the story of conflict of interest, where the story of conflict of interest, take care about it, is impossible to stop. You can create Chinese walls, you can create rules, but at the end of the day, it's a story of human beings, okay? Because if there is a default on the loans that I gave to Sydney, you understand that I can lose my job, you understand? Okay? Or I have to come back to my house for Christmas and to say to my wife and to my son, I'm very sorry, but I don't have the bonus this year because of the default of the loans. And my wife and my son, they say, but every year you have a bonus. No, this year I don't have. You understand? This is the story of conflict of interest. And remember that I do hope that you don't find yourself in this situation, but you will stay in stories like that. This is the story of conflict of interest. Okay? If a bank is universal, it's obvious that we have a lot of human beings. There is a lot of interaction. You can satisfy customers. When we stay in good times, we don't have this problem, okay? Because you repay the loans, I don't have to give a call to Ludovico, and you don't have to sell the bond to Aldo, okay, when we stay in good times. No problem. All the customers are happy and satisfied, and also the managers. But when we stay in bad times, you have to survive. And if you have to survive, you have to manage the opportunities that you have inside the universal bank to reduce your personal risk. Okay? That's the story of universal bank. What's happening now in Europe, but especially in the United States, the problem is better that we come back to the past and we say banks must manage only commercial banking. Probably it will happen. But you check, you will see on the newspaper. But my personal opinion is that if Mr. Obama, United States, decided, and it's a story of 1 month, 2 months, that's my personal opinion, to say, I'm very sorry, this is the end of universal bank, and bank can manage only banking, I do think that also in Europe will do the same exactly. Okay, we will lose a lot of synergies, we will lose a lot of satisfaction, but we will survive. And the banking system will be safer, okay? This is the story. Sorry for that, but just to remember, okay, this crucial point. But let's come back to the point. Banking Act, definition of banking activity. We identify a player which is called bank, and the bank is universal, but inside the Banking Act, take care because it's relevant for our course of private equity, we have also another institution, and this institution is called investment firm. What is the investment firm? The investment firm is a financial institution that can manage exactly the same activities of the bank, but the financial institutions, the investment firms cannot manage banking activity. So investment firms can raise money through deposit, but cannot give money through loans, or an investment firms can give money through loans, but it cannot raise money to deposits. Examples of investment firms are leasing companies, factoring companies, consumer credit companies. These are examples of investment firms. Okay? The rule number 3 is that both bank and investment firms are supervised, and in every country we have a supervisor that controls these institutions. In Italy is Bank of Italy, in France is Banque de France, in Germany is Bundesbank, okay, in every country we have a supervisor, okay? But what is important is that to operate, both bank and investment firm need a regulatory capital. Both bank and investment firm to operate need a regulatory capital. Okay? The set of rules which regulate the regulatory capital are named, you know the name of rules that regulate the regulatory capital? Basel II, the Basel II. Okay? Basel II is the system which is inserted in the Banking Act, and Basel II regulates the regulatory capital for banks and for investment firms. The issue is very simple. The higher you invest and or the higher you take risk, the higher must be the regulatory capital. Okay? Is it okay, guys? So my first question is, banks and investment firms, in your opinion, can stay in the private equity sector? They can invest in private equity? This is a question for you. Absolutely yes, because we said that banks and investment firms can offer whatever kind of service, minus what? They cannot deal insurance activity, and they cannot act as entrepreneur. So we have to say, okay, from a logical point of view, both banks and investment firms can invest in private equity, but probably we have some limits, because we have to understand when a bank or an investment firm became an entrepreneur, and when a bank and investment firms still remain an investor. You understand? Because if the bank or an investment firm became an entrepreneur, it's not possible to do that. But till now we can say, okay, banks and investment firms are two vehicles which can invest in private equity. But we have also to discuss about the Financial Services Act. In Financial Services Act, we identify three issues, like in the Banking Act. The first problem is, take care, just 5 minutes. I know it's a bit boring, but it is fundamental, because if we don't know the picture of European Union regulation, it's very hard to start discussing about private equity. So we have to do that. Financial Services Act, what is the first issue we have to identify? Like in the Banking Act, our first issue was to give a definition of banking. In Financial Services Act, the first problem is to give a definition of financial services. Okay? Do you know the definition of financial services? You know the European definition of financial services? Financial service is whatever kind of activity which is based on a security. Financial service is whatever kind of activity which is based on a security. Securities are bonds, equities, derivatives. These are examples of securities. Can you give me examples of whatever kind of activity you can do on securities, just to have an idea? Trading, so you buy and sell securities, okay? Advisory, given to customers that have to issue securities, advisory. Trading, I do prefer to use another name, which is dealing. Dealing, advisory, other activities. It stay in the advisory, right? Another job, which is classical financial services, brokerage. Okay, you have to sell securities, and I act as a broker in order that you can sell the securities. Or you have to buy securities, you can give a call to Stefano and to say, Stefano, I need to buy 50 million euros of UniCredit. They are very cheap today, so, okay, I can act as a broker and to buy UniCredit shares, okay? Other examples of financial services? Sorry? Custody, okay, it's a minor issue, but I would like that you mention something more important. Custody is the technical issue to do something more important, which is portfolio management, okay? You can manage portfolios of your customers on an individual basis, but also I can manage your portfolios all together, okay? They are financial services. So dealing, brokerage, advisory, and portfolio management. These are classical examples of financial services. The problem is, okay, that's great. Who are the players that can manage financial services? And this is the topic number 2. Like in the banking system, we said, okay, who is the player that can manage banking? And they say banks, but you have also another institution which is investment firm. Also, in this case, our problem is to say, okay, who are the players that can manage financial services? And in this case, we find 2 different players. The 2 different players are financial services firms, and asset management company. So we highlight 2 different financial institutions, financial services firms, and asset management company. I do hope that the second definition is self-explaining. Asset management company are devoted to asset management, which is portfolio management, the management of wealth of other people, okay? Inside asset management company can use a specific tool, which is not a financial institution, but is a tool that can be used by asset management company, and this tool is named fund. This is a critical tool because more than 70% of private equity in Europe is managed using this kind of tool. Okay? So please take care about funds. Issue number 3, also for these financial institutions, you must have a supervisor. In the Italian case, just to have an idea, we have a double supervisor for those institutions because we have Bank of Italy and Consob, more or less the same in France, in which we have Banque de France and COB, Commission Bancaire. Okay, we have supervisors that supervise those financial institutions, but what is relevant is that we don't have regulatory capital. We don't have, in this case, regulatory capital. For what reason? Because the financial services firms and asset management company don't invest their money. They manage and they invest money of other people. But because they don't invest their money, they don't need the regulatory capital. Okay? So no regulatory capital. Okay? So, this is the general framework of regulation in Europe. As we mentioned before, private equity can be managed by bank and by investment firm. In financial services world, financial services firms, from a logical point of view, they can manage private equity, but they are not the proper vehicle. For what reason? Because financial services firms generally are advisor, are broker. The vehicle which is properly suited for private equity is asset management company through fund. So at the very end of the day, if in Europe you want to manage private equity, you have 3 different vehicles, and you have to discuss about that. You can use a bank, you can use an investment firm, you can use a fund. Because private equity is a financial service, you cannot use other vehicles. So in Europe, if you want to invest in private equity, you have 3 options. You have a bank, and the bank invests in private equity. You have an investment firm, and investment firm invests in private equity. You have a fund, and the fund invests in private equity. No other options, no other solutions. Okay? The game now is to understand the functioning, the working of these three vehicles investing in private equity. Okay? From a logical point of view, I start from banks, I jump into investment firms, and I move to funds. What is fair from me is to specify that in terms of usage and in terms of volume of activity is exactly the contrary. The leading vehicle is the fund, the second vehicle in terms of volume is investment firm, and the last vehicle is the bank. Okay? In order that you start to have the right proportion. I start from the bank from a logical point of view, because the Banking Act was created from the first in 1993. From a logical point of view, and in terms of teaching strategy, it's better to start from the banking system. But I do want that you start to remember that in terms of volume, in terms of usage of this vehicle is exactly the contrary. Fund, investment firm, and bank. Okay, till now, just a thing. For people that doesn't remember perfectly the framework of Banking Act and Financial Services Act, however, the slides for the session number 4, the session of today, are really full of informations about Banking Act and Financial Services Act. So in the classroom, I position my speech in a sort of compromise between people that know everything about Banking Act and Financial Services Act and other people that don't remember or they don't study yet the problem. So it's a sort of compromise. In the slides, you find a lot of details about the two acts. So if you want to recover information on news, you can do that through slides. But now the problem is, okay, let's start to play this game. Now, really, we enter the playing field of private equity. We start discovering who are the players, who are the private equity investors. Okay, it's time to do that. The first player is the bank. For what reason? Simply because we said the bank is a universal and private equity is one of the financial services. So a bank can invest into private equity. What kind of private equity? Whatever kind. Seed, startup, early growth. It's a strategic problem for the bank. Identify a cluster. You understand? But I can do that. Our problem is the following. A bank is free to invest in private equity. That means a bank can buy shares of not listed company without any constraints. This is the problem. Because my speech would be very short if I say no constraints. And so my speech is simply, guys, remember that a bank can invest in private equity. That's it. Okay? But my question is, a bank has a constraint in investing in private equity? And the answer is yes, there is a double constraint. So if a bank invests in private equity, we find a double constraint. The constraint number one is regulatory capital rule. The constraint number two are special rules for equity investments. So if a bank invests in private equity, we have to manage a double level of constraint. The constraint number one is a general constraint. General means is a constraint, take care about it, not only for private equity, but is a constraint for whatever kind of activity of the bank. But is a constraint also for private equity, regulatory capital. The second constraint is designed for private equity, because the second constraint is a set of rules devoted to regulate the equity investment of a bank. So we have a double level of a constraint. Okay, guys? Let's start from the constraint, from the rule number 1, regulatory capital rule, which is driven by Basel II regulation. I don't want to discuss about Basel II because we need a course to discuss about Basel II, okay? Just simply to remember the mechanism of regulatory capital. The mechanism is very, very simple. In whatever kind of bank, there must be an equilibrium, a relationship between the asset side and the equity. In every bank, there must be a relationship, an equilibrium between the asset side and the equity. Okay? Because there must be an equilibrium, sorry if I say it, if I mention it, we don't use the word equity for bank, but we do prefer to say regulatory capital, because the amount of equity in a bank is not free, but is driven by regulation. We do prefer to say regulatory capital, okay? The rule is very simple and says, okay, there must be a proportion between regulatory capital and the asset side of the bank. And you know what is this proportion? Regulatory capital of a bank must be higher than the 8% of what? Of the sum of the asset weighted per the risk. Okay? The rationale is the more you invest and or the more you face risks, the higher must be your regulatory capital. Okay? So if you have an increase of the size of asset and or an increase of weight which represent the risk, you must have higher regulatory capital. Okay? This is the problem for today and for the next month, why there is a big debate of the entrance of governments in the banking system in US, UK, Italy, France, Germany, whatever kind of country. For what reason? Because nowadays, in the banking system, risks of assets are tremendously high, and the regulatory capital is under the 8%. Okay? The shareholders of every bank don't want to invest in the bank. For what reason? Because the stock exchange is tremendously low. So if Mr. Unicredit or Mr. Goldman Sachs or Mr. Deutsche Bank says, I would like to raise money from the shareholders, the answer is, we are very sorry. With this level of prices in the stock exchange, we don't want to invest in a bank. And what is the solution? The solutions are only two. We started to sell assets, but today we don't have liquidity, so you have to find a buyer, or you give a call to the government and you say, dear government, please become our shareholder. Okay? It's simple. No, it's not so simple, because in every part of the world, in the law is written, in Europe, US and UK, that governments cannot be shareholders of the banking system. And we have to modify laws to do that. And governments have also to find money to do that. Because to modify a law is very simple. It depends from your parliament. But even you modify it, you have to pay the bill and to say, okay, now we have to invest in the bank. And if you don't have money, what you can do? We gave a lot of money to cars producer. We want to increase taxation to find money. I don't know. It's a big debate, okay? But this is the problem coming from this kind of rule. So, for private equity, what happens? Private equity is one of the activity, right? Is one of the activity of the bank. So every time, every day you invest in private equity, you are a bank. Please remember, you must have a regulatory capital, okay? The more risky, sorry, the riskier is your private equity investment, because you invest in seed, you invest in restructuring, the higher must be the regulatory capital, okay? So your positioning into different clusters of private equity has a strong impact on regulatory capital. If you don't have regulatory capital, I'm very sorry, it's very difficult that you can invest in private equity. Okay? Is it okay, guys? This is the regulatory capital rule. Next week, we have to start from this point and to say, okay, we don't have simply a general constraint, we have also a specific constraint coming from special rules for equity in investment. Okay? Okay, we see next week on Monday.